Let's begin with a look at some of the trading updates that we've seen. A bit of a mixed bag. Capitec, up, different sectors of the economy, but the story remains the same. There is recovery that's coming through. Let's begin first of all with Capitec. Results 30 to 50% ahead of what the market was expecting.
Well, it's a trading update for year-end results to the end of February, and I think it indicates that Capitec is a very simple bank, targeting a very niche end of the marketplace, the unbanked, people who want simple banking facilities. The trading update, 30 to 50% up, indicates that it's doing extremely well.
And I suppose this also sort of vindicates indeed those shareholders who refused to take that PSG offer, and also suggests that PSG knew what they were doing. They'd seen something that was right. Capitec is the place to be.
Well, possibly. I was at PSG last week. They're a sharp bunch of people there in Stellenbosch, and I have a lot of time for them. And I would imagine, given they own a large chunk of Capitec, they understood how well the company was doing. And at a current price of 75 Rand, I think they offered to try and take the company out. Possibly was on the cheap, and I'm glad the company remains listed. It's a great business.
But given how well this company has performed in difficult times, would it now be time to bail out and perhaps look at the bigger banks, because now they will be starting to get some kind of traction into their businesses and perhaps get better returns going forward?
Well, possibly, but it all depends where you want to be. Capitec is a very simple platform. It's open long hours, 8 till 5. It's a very technology-based system. It targets primarily the underbanked, or let's say the lower end of the marketplace, with quite rigorous controls. And that part of the market is still not that well covered by the big four leading banks. I think Capitec knows what it's doing. It's gone from zero to hero in the last few years. And I think given that PSG wanted to try and take the company private, it probably shows you there's a lot more growth coming from that company yet.
Yeah, and I suppose that's quite understandable, given we know that the expectation was that Capitec wouldn't survive after the blowout of the mid to small banks. But let's move on to another sector, Upholdings. Interim results that we saw the other day, revenue perhaps down 20%. Hardly surprising given the state of demand for cables that we know from construction has not been there.
No, it hasn't. Basically, with the rand dollar being so strong, the underlying price of copper, which is a main contributing factor to ARB's results, actually fell. There was also price deflation in cables of between 20 and 25%, and less demand. And as such, revenue and HEPS declined by about 20%. However, this company is sitting on 240 million rand of cash, market cap 450 million rand. It's expanding its national footprint, and it's moving into the SADC countries. As recovery happens in sub-Saharan Africa, ARB is extremely well placed to go forward, and I think at 2.25 rand, and it pays a nice dividend backed up by lots of cash. This is one stock that investors should be looking at on recovery for the next 6 to 12 months.
We'll mark your words. Anthony Clark will definitely look at that one and see where it goes from here on as the year progresses. Another rumbling story, One Time versus Kulula.com, of course, versus Kome, the holding company. Now, simple story, competition issue. One Time CEO Glenn Osmond, we have heard, is alleging that Kulula's deal with the Lanseria airport is stifling competition. Do you think it's a case of just wasting his money?
I think this is an interesting one. At the end of the day, Lanseria is a private airport. It's owned by a consortium of investors, and in order to make the airport more viable, they actually asked a large airliner to come in to use Lanseria. Now that Kulula has been so successful there, and the fact you can go to Lanseria, there's easy parking, easy access, there's no queues, you walk onto a plane, you take off in a very short space of time, it's become a great success. So you can imagine that other low-cost airlines want to use that facility.
Absolutely.
However, Kulula signed a guaranteed contract with Lanseria, giving it exclusivity for a set number of years. That contract expires at the end of next year. So at the end of the day, I can see why One Time wants to move to Lanseria. Its customers want an easier airport facility.
Sure.
However, a contract's a contract. So I think One Time, yes, they can try their luck, but I think maybe they're wasting their legal money.
Indeed, maybe money they should be spending trying to shield the business from the tough times. Let's look at your stock picks for the rest of 2010. Have you changed your mind since the beginning of the year in terms of the recovery that we have seen and where perhaps you ought to be placing your money? But I do see one of your favorites, Mazo, is getting up to lifetime high, 365 cents.
Yes, Mazo's been one of my favourites for quite some time. It's in glazing and aluminium products, primarily in the Western Cape, but expanding nationally. It hit a high of 365 yesterday, sitting on 246 million rand of cash. Again, a company that I like with a good cash balance. Other stocks that I'm looking at right now, bearing in mind your ArcelorMittal comment earlier, all the steel stocks, Argent, Alert Steel and BSI are my current favourites. I'll be buying a basket of those companies going forward for recovery, principally Argent, who I'm seeing next week. week for a management update. Other stocks I'm looking at is Buildworks in the power infrastructure sector. It was hit down last week to 42 cents. It's now back to 54, sitting on 265 million rand of cash, market cap 450 million rand. So those remain my favourite stocks going forward. Many of these stocks will be at a conference that I'm organising in about a week and a half's time, and I think there are many stocks out there that are looking ripe for recovery. They have good strategies, good management, and most importantly, sitting on heaps of cash.
Absolutely, Anthony Clark. I'm beginning to like the turn of this story that we're taking. It's definitely taking a different turn from what we were talking last year. Hold on to your cash, watch those cash balances, etc., etc. Now we're talking like normal markets again.
I think at the end of the day, I think investors out there should be looking for stocks that have been unloved by the larger institutional investors who had to run away due to mandate changes or redemptions. And I think you'll be quite surprised of a number of small to mid caps out there that are completely under-researched, completely unloved, and a little bit of kicking the tires can turn up some really good gems.